Okay, let's jump right into this explainer. Today, we're putting on our detective hats to uncover a massive, hidden risk that is quietly building up in the background of our economy. We're talking about a $2.5 trillion tidal wave in the private credit market, and almost nobody sees it coming. It's a fascinating, honestly, kind of terrifying story, and we're going to break down the whole shebang step by step.
Because there's this really strange disconnect happening in the financial world right now. You look at the stock market today, and what do you see? Vertical charts, massive hyper on AI, right? Everyone's popping champagne. But if you look over at the bond market, which is usually so boring and predictable that people call it the adult in the room, well, the adults are completely panicking. Warning signs are flashing bright red. So why are the pros freaking out while everyone else is partying? Let's find out.
Section 1. The silent market alarm. To figure out what's triggering this alarm, we have to start by looking at the 30-year Treasury yield, which recently spiked to its highest level since 2007, all over the place. The US, the UK, Germany, Japan. The global bond market is practically screaming at us. But, just to make sure we're all on the same page, what exactly is a bond yield? In the simplest terms, a bond is just an IOU. Whether a government or a corporation is issuing it, it's just a promise to pay back borrowed money. And the yield? That's the exact borrowing cost of that money. It basically tells us the underlying price of money in the economy at any given second.
And there's this absolutely crucial inverse relationship you have to keep in mind between a bond's price and its yield. It's kind of like a seesaw. If buyers don't want your IOU, the price drops, which means the yield shoots up. So when we see yields rising across the board like they are now, it means buyers are demanding much higher returns to lock up their cash. This usually happens for a few reasons, like the Fed raising rates, inflation fears, or just way too much debt flooding the system.
Section 2. The floating rate trap.
So while those long-term yields are definitely scary, the Federal Reserve has actually set a massive trap on the short end of the yield curve, and it all revolves around one number, 5%. That represents the crazy spike we saw in a rate called SOFR, the Secured Overnight Financing Rate. You can basically think of SOFR as the overnight receipt for the entire U.S. financial system. Back in early 2022, SOFR was sitting at effectively zero, free money. But as the Fed aggressively hiked rates, SOFR rocketed up to over 5% by mid-2023, and it has just stubbornly stayed there.
Now, why does that matter? Well, when most of us think of debt, we picture fixed-rate debt, like your standard home mortgage, right? You lock in your rate, and your monthly payment literally never changes. It's safe, it's predictable, but there's a whole other beast out there, floating-rate debt. The interest rate on these loans isn't locked. It's tied directly to a benchmark, which is almost always SOFR. So imagine having a loan where, when SOFR spiked from 0 to 5%, your required interest payments just absolutely skyrocketed overnight. That is the exact trap thousands of companies are sitting in right now.
Section 3. Finding the first cockroach.
To see how this floating rate trap plays out in the real world, we don't have to guess. We just look at the market. Let's walk through this wild case study. Back in 2021, a software company called Pluralsight was bought out by a private equity firm for over $3 billion. To pull off the buyout, they loaded the company up with over $1 billion in private credit loans. And here is the kicker. Those loans were floating rate, pegged right to SOFR. For 3 years, while SOFR was basically zero, everything was fine. The math worked perfectly. But when SOFR spiked, Pluralsight was completely underwater. Their interest payments became mathematically impossible to make. By August 2024, they officially defaulted, and their private credit lenders had to swoop in, inject emergency cash, and seize 85% of the company just to keep the lights on. It wasn't a bad business. It was a perfectly fine company that drowned simply because its debt was tied to a floating rate.
Which brings us to this absolutely brilliant quote from JP Morgan CEO Jamie Dimon when he was talking about cracks in the credit market. He said, "When you see one cockroach, there are probably more." It hits the nail on the head because Pluralsight was not some unique, isolated failure. It was just one borrower in a massive pile of companies that all took out private credit using that exact same floating rate structure. Pluralsight was just the first visible symptom of a much larger systemic infection. And the data proves Dimon right. Get this. The Fitch private credit default rate recently hit 6% over its trailing 12-month measure. That is the highest default rate they've ever recorded since the index was created. No joke. So yeah, there are definitely a lot more cockroaches scurrying around in the dark corners of the private credit market.
Section 4. The PIK accounting trick. So you might be wondering, if defaults are at record highs and borrowing costs have completely exploded, why is the private credit industry walking around acting like everything is totally fine?
The answer is sneaky accounting. Let me introduce you to payment in kind, or PIK. It sounds incredibly polite, doesn't it? Like a friendly favor? But PIK is actually a very clever accounting trick designed to keep a struggling loan from officially being labeled as a default. It lets a distressed borrower pay their interest with, wait for it, more debt instead of actual cash. Seriously, look at the absolute absurdity of how this works. It's almost like a bank heist. Step 1. The borrower realizes they cannot afford their massive new cash interest payments. Step 2. Instead of calling a default, the lender says no problem, we'll just take that unpaid interest and tack it onto your principal balance, so the debt just grows. Step 3. The lender actually records that fake unpaid interest on their books as real income. And step 4, the craziest part, because a lot of these funds are legally required to distribute their taxable income, they end up paying out cash dividends to their investors based on money they never actually collected. It is pure financial illusion.
And if you look at the data, it shows how incredibly fast this trick is spreading. Right now, about 11 to 12% of private credit loans have these PIK features baked in. That's a whopping 72% jump since just 2021. And the scary part? More than half of those are classified as bad PIKs, meaning they weren't in the original deal, they were just slapped on later because the borrower was going broke. Across business development companies, roughly 8% of their income is PIK. In some extreme cases like FSKR, over 14% of their total investment income is quite literally just unpaid interest rolling over into a bigger pile of debt.
And to make matters even worse, you have to understand Level 3 accounting. Because these private credit loans are made in the dark and they aren't traded on public exchanges, there's no daily stock price you can just look up. Instead, funds use Level 3 accounting, which means they rely entirely on their own internal models to value the assets instead of using active market prices. They are literally grading their own homework. This makes it incredibly easy for them to hide the real damage that's happening beneath the surface. In fact, MSCI did some digging and found that over 10% of private credit loans are already being internally marked down by at least 50 cents on the dollar.
Section 5. The ticking maturity wall.
Now, you can hide losses on a spreadsheet for a while. You can roll unpaid interest into a bigger principal, and you can even look the other way and call a distressed borrower a performing loan. But eventually, the real world catches up. $85 billion. That is the staggering wall of loan maturities coming due between 2026 and 2029.
This right here is why we are staring down a tidal wave. All of these distressed, struggling companies are going to be forced to refinance very soon. And guess what? They won't be refinancing at those sweet, near-zero rates they got years ago. They are going to be rolling over that debt into today's punishing 5% plus SOFR rates. And remember all that PIK accounting? Because they've been paying interest with more debt, the principal they have to refinance is now significantly larger than when they started. Bad math does not just disappear.
So this leaves us with a final, pretty chilling question that I want you to take away from this explainer. When this $85 billion bill finally comes due and all these clever accounting tricks simply run out of road, who is going to be left holding the bag? The private credit story is just entering its final act, and the real-world consequences of this financial illusion are coming fast. So keep a close eye on the bond market, don't get completely blinded by the AI hype, and as always, stay curious.